So we're here with Janet Gutierrez, the best loan modification bankruptcy attorney here in San Diego, and we just wanted to quickly go over, what qualifies you for a loan modification, as you know, what a loan modification is and what qualifies you or pre-qualifies you to even go that direction when your property is in a little bit of a foreclosure situation. So yeah, we just kind of wanted to hear that and go over it.
Sure. Well, the most important thing is that in theory, the loan modifications, the program was designed to help people who were struggling and making their mortgage payments. But really the idea was that the banks like to refer to the 3Ds. So they were looking for things like either there was a death in the family, there was a divorce, or disability. And, really there are multiple other reasons to qualify based on hardship. But things like loss of income, some people lost their job, so they had a period of unemployment or underemployment. For example, during the toughest period in the economic recession, a lot of people were laid off. So the idea was that it was a way to kind of bridge that gap. So if you spent 6 months unemployed, during which time you didn't make a single mortgage payment, then the loan modification could do one of two things. Either they could put those 6 payments at the back of the loan, and then you could just start over ideally, or if it was also meant to assist people who signed really bad loans. So they were essentially in adjustable rate mortgages, and their payment was like 60% of their gross income. So the program said ideally people's mortgage payments should be 31% of their gross monthly income. And so the application process essentially consisted of the hardship letter, so stating what happened and what caused you to fall behind, and technically if there was a chance that your situation was long-term but not permanent, because you also couldn't apply and say I'm unemployed and I can't make my mortgage payment. Well,
Right.
You do need to have income in order to be able to be approved for a modification. Now the Making Home Affordable program is no longer in place. So now when people apply for a loan modification, they're essentially applying for an in-house modification. So it's really whatever the bank proposes. They may propose a fixed rate mortgage for 30 years, or they may propose something a little bit different where maybe the first 5 years they're paying 2% interest, and then on the third year it goes up to 3%, and then it caps at a certain interest rate. But in terms of the things that they're looking for, they're still essentially looking for the same things. They want to see a hardship, a well-documented hardship. So unfortunately, it can't be things like my payment was very expensive. I understand that is a hardship, and especially if you're in an adjustable rate mortgage and your interest rate is going up and your payment's going up, they're still going to want to look at your tax returns and see that there was some incident that occurred where there is documented loss of income. So either your hours were reduced, or you lost your income for some time, or again there was a death in the family, you went through a divorce, and now you have that loss of income, and you also may have other obligations. And then they look at the value of the property. That's something which unfortunately is sufficient to make some people not qualify. So even if you do have a well-documented hardship, it may very well be that your property has equity in it. So just based on that alone, the bank may refuse to offer you a loan modification. And another thing that I've seen is sometimes people apply if they have their budget is essentially negative. They have more expenses than income, and so that's another consideration. I think optimistically, there are still some people who qualify for a loan modification, but they should speak to someone and go through the net present value analysis that the bank uses. Go over that before they even apply, because the truth is that in a large percentage of cases, those people will not qualify. And so one thing that really troubles me is usually I'll meet with a client and they've paid like $2,000 here, $3,000 here, and $1,000 here to get help, when really just by going through the numbers we could have figured out that they did not qualify. So.
So then it saves, time and money and effort in that situation. And then if you don't mind elaborating, how many loan modifications actually get approved versus how many get denied?
So the numbers have changed. I mean, I know that I used to boast in the past, in 2008, 2009, I would say a large percentage of the modifications were approved. Now, granted, there aren't as many people applying, but I would still say it's, if I get like maybe 5 cases, 1 or 2 of them get approved. But to be fair, again, it depends on the circumstances. A lot of times, the hardship is not very well documented, or with property values going up, they have equity, so we knew that it was kind of a difficult case to begin with, that it was very likely that the bank was going to refuse the modification. So I'm not saying it's hopeless, but I am saying that before anybody spends any money or any effort in applying for a loan modification, that they should sit with someone and go over all of the factors and see if they're eligible first, and if they are eligible, if it's feasible. Because a lot of times, once we figure out, even with a modification, what the modified payment would be, it may very well be that it's not feasible, it's not affordable, in which case they should probably look into other options before they damage their credit further and and kind of prolong the inevitable. So
yeah, and then with that being said too, typically some loan modifications are like a 2-year modification. So in that case, is it in their best interest to do something like that?
Right, I think what you're referring to, I know for a while, Wells Fargo was one of the banks that was, they were putting people on these sort of forbearance agreements. And to be fair, the idea was that for people who were unemployed, it was supposed to give them a really low monthly mortgage payment for a few months, and then it could be extended. But what ultimately wound up happening is that all of these people wound up in foreclosure, because those months that they weren't making the mortgage payment and they were making that temporary payment, they were still accumulating all these arrears. And so the problem was that all of a sudden, once that program expired, they were $30,000, $40,000 in arrears. So at that point, a repayment plan was not an option, and forbearance wasn't an option, and they were in foreclosure. So definitely, I would say, be wary of anything where the only agreement is that you're sending less money, but you're not under any protection from your property going into foreclosure.
Right, because it seems like they just push the date back regardless. And with that being said, there's we hear a lot of those situations come out where people can't get a modification, and so they go into this mode of hearing this ad online about suing your lender to get a modification. And if you could just elaborate on what happens and how many cases have actually been won by anyone in the state of California specifically against a lender. Just, is it possible?
It's certainly possible to sue the lender, but the problem is that, at least what I see coming into my office, is that these firms, a lot of them in Orange County area, and will file basically the same lawsuit, just change the name of the client and the name of the servicer, but they essentially have this boilerplate lawsuit. And for a while, it was just a delay tactic. So what they were doing is they were suing in civil court, and then the case was getting removed to federal court. And so a lot of it was just the ultimate process being delayed. So if for someone who is just saying, I don't want my property to be foreclosed, help, my sale date is next week, if it was just delaying the inevitable. But in terms of them actually getting a judgment where the bank admitted wrongdoing and said, you're right, I didn't provide the proper notices, and here I'm reinstating you and putting the amount that you were behind in the back of the loan, that, as far as I'm concerned, did not happen. I've asked for people who've hired those firms to see if they wouldn't mind sharing, what their experience was. And what I often come across is that either the attorney was disbarred, or there are multiple complaints in the Better Business Bureau or online regarding being charged monthly fees. So
Right.
What happened is they would tell them, you're going to pay $1,500 a month and it's going to cover our litigation expenses
Mm-hmm.
and, all these costs. So every month the client is paying and paying and paying, but really the only thing that's happening is that paperwork is being filed, but ultimately there's no accountability there, because at least the clients that have come to me for a bankruptcy, because at that point that's their only option, they either sell or they file for bankruptcy, they can show me pleadings, they can show me a complaint, they can show me demurs and other legal documents, but I don't see anywhere where there's actually anything being where they've recovered anything. So I really, quite frankly, don't have faith in those types of lawsuits. I know that some people cite news articles and cases where Bank of America, Wells Fargo were fined. So have they been fined? Yes, absolutely, especially for things that they've done wrong during the bankruptcy process, maybe for failure to file certain notices and so forth. So they're fined millions of dollars, but it's not as if really that money gets, diverted to the homeowners at the end.
Right.
So I would say if anybody that's thinking about suing their bank, I understand the feeling of, my case is different, I have a good case, wait till you hear my set of facts. I can prove that they didn't apply this mortgage payment and they misapplied this mortgage payment. I understand, but I also have to tell the clients that they're going up against Goliath, one, how expensive litigation is. So it's very easy for those big banks to kind of bury you in paperwork and to, be scheduling depositions and, sending out subpoenas and requesting documents. It's a really difficult process. Most firms, at least small firms like me, aren't even equipped to handle them. And so they should be looking at, does this firm specialize in litigation? Can they give me a few cases, examples that where they won? And if the attorney says something like, oh, I can't disclose because of a confidentiality agreement, well, I mean, maybe not specifics of the of what the recovery was, but I'm sure they could cite the case, or so I really think that I would say proceed with caution. I personally do not believe that that's the way to go. I think most supposedly successful lawsuits where they say that a settlement was reached, what they really saying when they say settlement is that they were offered a loan modification. So why not skip all of that, save yourself $20,000 to $30,000, and just apply for the modification if that's really what you wanted? Because if what you're looking for is an admission of wrongdoing, good luck, that's not going to happen. And if what you're expecting is that they're going to forgive the amount that you fell behind because somehow they cost it, that's not going to happen.
Right. And then in the event, like we've been kind of talking about, people go and sue the bank when all of those funds that they're paying on a monthly retainer to an attorney just to file a complaint against the lender to get their foreclosure date postponed for a month, even sometimes a couple of weeks, which just keeps that fear inside regardless. That money that you're paying the attorney, you could, I mean, technically just reinstate the loan at that point. So skipping all of that, if your goal is to keep the property, wouldn't you agree that that money that you're paying an attorney could actually just go straight to your mortgage and you could skip all of the heartache in between?
Absolutely, especially if, let's say that the homeowner is actually not that far behind. Let's say that they're $30,000 behind, and so in a Chapter 13 it would cost I'm gonna use rough figures, but it'll for sure be under $1,000 a month to fund a plan where they're paying back those arrears and even attorney's fees. And let's say that they're paying even unsecured creditors some money and the trustees commission. Even then, they will be paying less than what they would be paying under that retainer with the firm trying to sue the bank. And so when they're paying that firm to file paperwork in that lawsuit, again, there's no guarantee that it's going to reduce the amount that they're past due. In all likelihood, that money's just going to be gone. And whereas it would make more sense if maybe they're past the point where they can reinstate, maybe they don't have all of the money in a lump sum, but if they can afford that $1,500 a month, then it might be better used in a Chapter 13 plan to at least be getting that homeowner to get caught up on those arrears over the next 5 years. So I think definitely that I encourage people to do some research, to meet with more than one attorney, see if they can see really any cases cited where what they're promising they're going to do, that they've actually accomplished that in the past.
All right, great. Well, thanks, Janet, for your
welcome.
time. Appreciate it. Just a real quick overview for everyone about, what a loan modification entails and why you would qualify for one. And suing your lender to get a modification when you could obviously go that route, it sounds like, in the first place.
Yes.
So, and Janet's a great point of contact for loan modifications as well as bankruptcy. So we like to let her advise people on that. And as far as everything else, we just are thankful that you're, explaining this to everyone who's in this situation. So thank you so much.
You're welcome. Thank you, and good luck, everyone.
We appreciate it.
Thanks.